Prices of other goods. I would say relative prices of other goods is yet another determinant or factor which affects supply. I'll explain. See, a firm makes two things, A and B. So what happens, as the price of A increases, the producer see it's more of a profitable process. So even though the price of B remains as it is, but price of A increase and it's become profitable. So what does a producer do? He shifts its limited resources from B to A in order to enhance his profit, which in turn increases the production of A but reduces the production of B, even though the price is same. So what do we understand? That if price of one commodity increases, it leads to decrease in the supply of other commodities. As the price of a commodity increases, producer sees it's a more of a profitable situation. So he shifts his commodity from non-profitable or reasonably okay profitable commodity to profitable commodity, which in turn enhances the original product's supply but reduces the other product supply. I'll explain this with a simple example. Let's say I am a farmer. I have 100-acre lands. In that 100-acre lands, I produce two things, rice and wheat. So what do I see? The price of rice has increased from 30 rupees kg has gone to 45 rupees per kg. So naturally, I see production of rice will give me much more profit. So what I'll do, out of that limited land which I earlier generally used to share in equal proportion with wheat, now I'll do what? I'll do only 10 acres of wheat and 90 acres of rice. So eventually what will happen? Due to shifting of that land, limited resources to rice, my production of wheat goes down, but my production of rice increases. So what happens when the relative prices of other commodities increases, it increases their supply but reduces other product supply. So what has happened, as the price per kg of rice in the market has increased, so naturally the production and the supply of rice will increase because the resources a farmer has will shift to rice instead of wheat. But in the whole process, even though the price of the wheat has not changed, but its supply will decrease because its production has reduced. The farmer has shifted its resources, limited resources, from wheat to rice in order to enhance the profit. I'll give you another example. I think this will appeal to you in a better way. Let's say I manufacture two bakery items. One is proper bread slices and another is cakes. So what has happened? Now there is huge increase in the prices of cake. Earlier I used to sell them at 120 rupees per kg. Now it has gone to 200 rupees per kg. So with those my limited resources, what I'll do, I'll use that dough, that raw material to make the bread. I'll make the quantity of bread less and I'll increase the quantity of production of cake, which in turn what happens? It will lead me to increase in the production of cakes and try to enhance my profit, but in turn it will affect the production and in turn the supply of the bread. So what has happened, due to increase in the prices of first commodity, let's say cake, I see there is an increase in supply of cake because the factors of production have shifted towards a higher quantity of production and hence supply of cake. So automatically the production of the bread has gone down. So the prices or the relative prices of other goods affect the supply of the goods.